Hey, Bob here again. 1st of December. This is the chart I want to show you. I talked about this a little bit earlier, but this is the PE ratio for the S&P index. And it started the year of 2018 at basically 14. Okay? And now it's at 19, which is just absolutely astounding. And this is the earnings estimates for that same period. So the entire stock move was based upon the growth in the multiple. This is unsustainable at any level. Even if it's the Federal Reserve buying that, this is just amazing. I mean, I can't even put it in words. And this is what people are worried about. You know, the stock markets and bear phases at a PE of 8. Okay, so we're now at 19 with no growth in earnings, 0. And I'm going to try to find a chart. I'll post a little bit later as soon as I find it. Show the percentage of the S&P 500 that have so much debt on their books that their interest charges now are exceeding the ability for them to generate cash. That means they've taken on so much debt to buy down shares. And that's what we're seeing here. This is the share buyback program, fostered by the Fed, and also basically CFOs and CEOs are saying, hey, I see no growth in the future. We're going to buy back our shares to reduce the float, increase the value of our company. But they're at a point now where they can't do it anymore. That's why interest rates cannot go higher. When these guys have to roll over these loans, and if the interest rates are rising, these companies only have 3 choices. 1, go bankrupt. 2, stop buying back shares and start cutting into their expense structure, which will affect their revenue going forward. Or 3, start issuing stock, which dilutes their shares and defeats the whole purpose of what they've done. So that's kind of where we're at right now. And this exuberance is really a function of basically the passive investing environment. Is everybody's just kind of sitting and whistling past the graveyard here. And when this thing rolls, it's like musical chairs. There's not going to be enough chairs for everybody that wants to escape with great profit. And this thing can literally disintegrate because nobody is selling because they're passive. And so it doesn't take much money to lift the market. But once selling happens, it's going to be like the elevator ride down, the old adage, escalator up, elevator down. And the thing is, it's like crying wolf until it happens. And we've seen it happen. We've seen it happen in 87, we've seen it happen in 94, we've seen it happen in 2000, we've seen it happen in 2008, we've seen it happen in 2011. Remember the flash crash? And now we're here again. And so we had a couple unnerving moves. They ended around 2016, a little bit in 2018, and so we're absolutely due. And then all the funding mechanisms they used are at extremes too. So they pretty much used up everything. And yeah, can it blow off more? Yeah, but typically these blow-offs get reversed, and it goes all the way back to the beginning of this bubble move. That's pretty much when President Trump was elected. So that's where you need to look at, and to bring valuations back in line again. When it gets to there, it has to be cut in half again. So I'm not a perma bear or perma bull. I only look out a couple weeks at a time. But if I was an investor long term, I'd be in cash and or buy the things that have been suppressed, like gold and silver miners. You guys have a great day. Catch you later. Bye.